Hi, this is Billy of Peterson Wealth Services. This is our point of view for September 27th, 2022. I wanted to spend a few minutes today to talk about the recent market volatility stretched to the downside of the last 2 or 3 weeks. Now, this is a continuation of what we've seen all the way back to January of this year, and the market's been in pretty much an extended decline. We've hit a bear market. We've dropped further than 20%. As you know, that is the definition of a bear market. We've actually hit this historical definition of a recession, which is 2 quarters of negative GDP. There's a lot of animosity right now on, are we going to acknowledge that we're in a recession? Are we not in a recession? There still seems to be quite a bit of spending. If you look around and you go out to dinner or you're driving around on the freeway or going on a vacation, it seems to be a lot of money still in the pockets of people, and they're spending. We've seen a change a little bit in the spending habits of folks. They've changed from maybe buying things and consuming goods to consuming services and experiences. So of the lockdown that we've seen for 2 years, uh, extended from 2 weeks to 2 years plus, people now want to get back and pick up things that they lost out on, which were vacations and spending time with family and traveling. So that's where some of the money is being shifted. We're still spending money, and that's really why we're in this predicament, if you will. Is the Federal Reserve is seeing that inflation is a significant problem and a threat to the long-term sustainability of our economy, and they are really trying their best to rein that in. So if you think about it, step back for a minute and say, well, just what's going on? Why is the market doing so poorly? Well, the economy is doing too good. So if you think about it that way, maybe it doesn't sound so threatening, quite so threatening. They're raising rates to calm an economy that's doing too good. Now, let me go back and start from that level then. Why is it doing too good? Well, go back to the pandemic. We had a shutdown of our economy, lockdown. We had then the government stimulus, which they figured they better buy their way out of that decision, and printed and pumped $6 trillion into the economy to hopefully, or the idea was to assist it. Now, sooner or later, I mean, if you or any type of economist or strategist or understand dollars and cents, you realize that there's a lot of money, way more money in our economy than there's ever been before. And when you have created new dollars and thrown those into the pot of dollars that were already in circulation, well, it just makes sense that the dollars that were already in circulation would be worth less. Now there's so many of them. So think about it. If you had a painting, it was a rare painting, there was only one, it's worth a lot of money. But if you have 500 of the same print, all of a sudden all of them took on less value. So it's the same thing with dollars, and why we're having inflation, because now they are worth less. There's too many in circulation. So go back to why that happened, what caused it, why we're here now. The Fed's trying to pull that back. You're getting a lot of misinformation and incorrect information, and sometimes flat out lies out of our politicians and the White House. And I've talked about this to great extent in past videos. So not to get bogged down in politics, but I want to spend some time talking a little bit about why we're here, put some historical context around it, show you a few charts, and then decide, where we're going and how long might we be in this situation. Okay. So we understand we're in a bear market. You may be nervous out there, and we understand the feelings. Believe me, this is the hardest time to be an investor, when things are unsettled, when there's uncertainty, when people are nervous, when you're looking and listening to the news media and you're hearing negativity and the market's going to go down way further and we're going to be in a complete collapse. And so this is when all the doomsdayers come out, because they'll get a lot of people tuning into them, listening to them, and they can sell their product, or they can even just get uh, on media exposure, have media exposure, which is again power, and some people really like that. So remember, when we start out investing, for most of you who've been in and working with us for a period of time, you understand that the biggest thing we focus on is your plan. We create a custom plan for you, because the plan is going to tell us how how successful you are going through your life and meeting all the goals and objectives that you have with your money. So we're not just here picking stocks and throwing things around and moving things in and out. We create the plan, and then in that plan, we have the probability of success. But remember, the probability of success includes market declines. So we've already planned on things like this. It's part of the overall long-term investor experience. As uncomfortable as it is, and as we don't enjoy being involved in these declines, it's already something that we have prepared for, planned for, and we expect. So remember, fall back on that as you're getting uncertain, as you're becoming more and more anxious. We are thinking about the long term here. The charts, if you remember the charts we've showed you over the long term, and we showed you charts that date back to clear back into the early 1900s for the stock market itself. A lot of ups and downs through that period of time. A lot of ups and downs. There's never going to be a straight path up. You're going to have to experience that up and down movement. But remember, there's never been a period where the market just dropped and then went to zero. And that would be catastrophic if everything went to zero. What would cause that? What would be the outcome of that? Would mean every company that we own, every company in the market itself would go to zero, basically out of business. So bankrupt. The stock price would go to zero. Now, if that happens, I would suggest to you that our dollars are not worth much anymore. Our biggest concern would be just finding food. So let's hope that we never get into that scenario. We've been through all sorts of wars and conflicts, and the markets have continued to perform over time, averaging about 10%, a little over 10% per year. Remember that. We're going to get out of this. The market's going to recover, and we're going to be fine moving forward. But I understand the concerns. Remember, this is tough. This is an environment that we have to try to be smart. And one thing that I always recommend to investors is play offense rather than defense. When you're in an environment like this, when you get the ball, in other words, you're playing offense, you have the ball in your hand, you have now control. When you're playing defense, you have no control. You're worried. You're waking up every day, seeing the statement, looking at the market, seeing how much your portfolio declined in value. So how do you play offense? You start taking advantage of the market. So take advantage of what you're given. You penetrate, you work through the defense that's right now in front of you, and you actually buy while the opportunity is making itself available. Let's talk about a little bit about what I mean here. If we look over history and we go back and kind of consider where the market has been and what might it take to get back to the old high. Remember, when I said the old high, some people would say, well, it might never get back to the old high. Well, I would disagree with you on that. Has there ever been a time, name one, that the market has declined and never got back to the high it reached prior to that? And please don't tell me this time is different, because I've heard that 1,000 times. We're always going to have struggles. We're always going to have things we don't like. There's always going to be something out there in the world that scares us. But the markets find a way to bounce back from those, and we will do the same here. So if you're a pessimist and you say, well, let's say it's going to take 5 years for us to get back to the high that we reached in January of 2022, that would mean we're going to need to recover 37.7%, and that means it's going to be a full almost 7% per year. So I'd ask you, are you happy? Would you be comfortable with a 7% annual return on your investment? Because that's what it would average from this level, roughly, to get back to the old peak. This chart right here is actually produced in June 30th, 2022. We're down a little bit more from this level. So just want to make you aware that these numbers are actually going to be a little bit bigger than they show here. Now, if you think maybe it's going to be a 3-year time frame to get back to the old peak, you're going to average about 10% on your money from here. So you'd be comfortable with that. Most of you would be really happy with that. What about new money? New money, that's going to be upside from here. Not just getting back to where you were, but actually positive growth on that new money. So think about, again, playing offense. Let's look over here at bull and bear markets. This is going back clear back to the 1920s, and you see the bull market, the period of bull market, how much return we had in each one of these time frames, and how long it lasted in months. And so go back down here to the bottom, and you see each of these bull markets, when you average them out, about 51 months. So over 4 years, and the return was 162%. Now, switch over to the bear markets because they're going to happen too, although they're way less severe, about 1/4 of the extent of the bull markets, and then about less than 1/2 of the extent. So 20 months is the average. Now, I will tell you there's a couple of outliers in here that really lasted way longer. So if we took this Great Depression 1937 year out of the equation, which was, everything bad that could go wrong went wrong. We didn't really know how to manage through it as a country. Government didn't really know what they were doing. A lot of people would say they still don't, but we have learned from mistakes of the past, I hope, and we've kind of figured out some ways to offset some of these declines. So if you took that out, the extent of the duration on average is going to be much less, somewhere closer to 12 or 13. Now let's move on forward and talk about expansions and recessions a little bit more. So again, this is what I was talking about earlier, is this Great Depression. The circles represent the extent or the time it lasted. So 4 years, but also the severity of the decline. So the higher the circle is on this chart, the longer it lasted. The larger the circle equals the it's a much bigger decline in real GDP, gross domestic product. So again, Great Depression was the largest by far in our history. We had another one here post World War II, demobilization. We had a 12 or 13% decline in GDP. And then we had several pockets of recessions here throughout the 70s, 80s, 90s. Most recently, we had the pandemic recession. Now, most people won't even remember this, but we declined 10% in real GDP. It was so severe and so quick. It happened. It lasted not quite a year, maybe 6 months. And, we just kind of infused a lot of money to buy our way out of that. It was policy driven. Some people still think it was necessary. I'm one that disagrees with that. I think the government, if left alone, makes tons of mistakes. They are the worst managers of money and capital on the planet. They, as a general rule, make things worse. They're awash with cash. They don't ever have any discipline with the money that they're dealing with because it's like a money tree. So government entities are notoriously poorly ran, and we saw a huge decline here just based on fear, a huge amount of fear that was sweeping across the world, especially here in our country, and lockdowns that caused this decline. Then again, to buy our way out, we print tons of money and pump it into the economy. Now we're paying the consequences. I warned you of that several videos back, almost 2 years ago. We warned of the pending inflation was going to come. And of course, now you have lies after lies that we really don't have inflation, that it's not bad, that it's being managed, it's only inching up incrementally. Okay, we're going to get out of the inflation environment sooner or later because the inflation is measured year over year. And so as they start measuring year over year going into next year, it's going to look a lot less severe. So instead of running at 8 or 9, it's going to be running at 4 or 5. And so that's going to start giving people a little bit better perspective, maybe a little bit better feeling about inflation as a whole, and the Fed may sooner or later be able to actually reverse course and start easing again. But this just helps us understand perspective on how long do these recessions last. Well, about less than 1 year on average. And it says over here 14 months, but I kind of take this as a bit of an outlier that we shouldn't see happen again. I never say never, but this was disaster written all over it. Unprecedented here, but didn't really know how to navigate through it at the time. Finally, let's kind of compare where we're at to in the market to real estate. Remember, the market is always first. It leads the declines in the economy. Why? Because it's the most liquid. It's the most liquid, which gives it a lot of benefits and pluses, but I'm going to drag this over just a little bit more. it gives us a lot of pluses because it's liquid, we can buy and sell quickly, but it also, for the same reason, is negative, buying and selling quickly. And when people get panicking, and buying and selling means more selling, and the markets go down further than they should. And that's all due to fear. But let's compare it to real estate. So this chart on real estate, this is residential real estate, so in other words, homes, goes back to 1982. And this is the interest rate on US mortgages. So you can see the interest rate started in the 1980s, clear up here in close to 18%. And they've fallen steadily. Now, there's been some short-term spikes during that period of time, but for the most part, we've been on a decline in mortgage rates, interest rates, and mortgage rates lockstep. Home prices, on the other hand, you can see here we started, and you can see this is a year-over-year price change. So are they going up or down? We had a big decline in home values in the early 90s. Then we had a really good boom in real estate for quite a period of time, 15 years. And then, of course, we had the real estate collapse, 08 and 09, significant drop in value. And then we back up way past trend line, kind of rode along the trend line for a while, and then take a look at what happened here in just the last couple of years. Now, unprecedented gains right here and way above trend line. So I am just warning people right now, if you don't think real estate is going to decline, I would encourage you to think again. This is going to go back to trend line. To go back to trend line, it needs to fall well below trend line for a while in order to get back to the long-term averages, about 4%. So that's what real estate does, 4 to 4.5%. Stocks perform 10 to 10.5% over the long term. So as stocks have already fallen well below their trend line right now, they're going to have to recover significantly to get back to that level. Real estate, on the other hand, is in the early stages of the decline. So they're in the first inning of this. Home prices, again, less liquid. People are still thinking it's okay, but as interest rates have spiked now, you're going to see it's corresponding to down here that the values will drop. So pretty much every time you see a spike in interest rates, if you look in the, let's say, late 90s, you're going to see a decline. We had a little bit of a decline here. We had the decline here in home prices in 2000. Due to this spike, we had the decline in let's see over here in spike right here in 2013 or 14. We had the decline here in values. So you're going to see a corresponding decline in home prices as the interest rate on these mortgages continues to shoot higher. June, it was 5.5%. Now we're well over 6% on the home mortgage. Housing inventories, you can see the spike here in 08, 09. It actually started to build in 06, but there was so many homes being built just on the speculation of being able to sell them. Remember that period of time? Most of you do. But this was the housing collapse, and this was all created by, once again, dumb policy decisions, no regulation on banks, encouraging banks to loan money to everyone almost, and then everyone got caught with their pants down, and we saw the biggest housing collapse in the history of our country. Now you can see the home originations on these mortgage originations, I should call them, the credit quality. Let's look back on that. When we go back to 2003, 2004, 2005, 6, you can see that a very large percentage of the total originations was to these subprime and mid-prime home buyers, the credit scores, under 660 and then under 760. So very large percentage of the totals. And that's where we had our problem. And that's why we had the collapse, and a big part of the collapse in real estate, because people couldn't afford them. Now over here, more recently, look at the credit scores for the most recent couple of years. By far and away, the largest is 760 plus credit scores. So even though values need to come down, I don't believe we're going to be in a complete collapse of 30 or 40%. And I think most people are going to be able to hold on to their homes. I don't think this recession is going to be as detrimental or extensive as what we saw in 07, 08. So remember, 07, 08, housing started the collapse. It was really the banks and the subprime mortgage loans that created the problem. But stocks took off to the downside just as fast or faster because, again, the liquidity. And then they hit the bottom before real estate did. Everything got wiped out then, not wiped out, but suffered major consequences. If you were a long-term investor during that period of time and you were able to either buy real estate or buy stocks, you turned out very well during that period of time when things bottomed and started back up. So I just encourage you to think about your long-term plan. If you don't have a plan, you should think about having us prepare one for you. Think about your success ratios. Think about the declines if they've been factored in. Think about what you can do to play offense in this environment, because it's those decisions that are made during periods like this that really matter. And if you want to help your returns when you come back in for your next review, your returns are going to be significantly enhanced if you're able to put money to work while the opportunities are the ripest. I do know that that's the hardest thing to do. Trust me, I've been in this business for 26, 27 years almost. And it's always tough to see investors or ask investors to put money to work when they want to the least. Most people want to invest when everything feels good and it's great and everybody's doing well. But it's times like this when you actually make your money and when you actually help your total returns out. So keep doing it. If you're a 401k investor, putting money, deferring, keep doing that. Now's not the time to get conservative. Now's the time to think about what you can do to keep buying while the market's down. I'm not saying it's going to completely turn immediately, but sooner or later the Fed's going to stop or pause, and that's what the market wants. They don't want to continue to see rates going up, up, up. There's another meeting on November 1st and 2nd. Fed's going to raise rates again, so plan on that. And then we're going to see them hopefully assess what they've done, and maybe going into mid next year, they might see inflation starting to be subdued and they can actually stop or pause long enough or even talk about future cutting rates again. I believe these November elections are going to be something the market's also watching. So the market wants a change. It wants a change of the spending habits. It wants a change of what we're doing as an economy. So whether you're a Republican or Democrat, doesn't matter. Change is usually good in a market like this. So that would mean a change of power in Congress. And I believe that's something that we should expect and plan on. And I do believe that's going to be another catalyst for the market to turn and start going higher. So last time I said we're about in the seventh inning. I think we're top of the eighth inning right here, 2 outs in the top of the eighth. I think the market has maybe a little bit more on the downside, potentially just with the uncertainty, the news flow, the interest rate scenario and the inflation scenario hasn't been subdued yet or hasn't been appeased yet. When that happens, we have a pretty significant bounce back. And that's the hard part, is to stay on the sidelines and expect you're going to get in on that and wait till the market gets better. You'll miss out on probably half or more of the increase. You'll probably get back in. Most people, I'm telling you, I preach this all the time. Most people who get out, they don't get back in until well past the level that they got out. So it's going much higher. Then they want to potentially get back in, or maybe they just give up on it altogether. I know it's tough sometimes to stay focused on the long term, but we're all in this together. People don't out there don't know things more than you do, so keep that in mind. People that are making changes or jumping around are more or less just giving into the fear. So call us if you're at that level or you're thinking emotionally rather than logically. So we hear you. We want you to know that. We acknowledge that fear. We understand it's real. But we want to go back to the long-term numbers, the metrics, the understanding of what works to be successful. Thanks for joining me today, and I'll talk to you next time. Hang in there.